How do you get an educational loan? Hello, this is Jaden Gumindish, Director of Travco Education. And in today's video, we are going to be covering a very important topic asked by almost every student going abroad. And the question is, how do I get an educational loan? So let's get right into it. Loans are divided into three major categories. At number one, we have your traditional bank loans such as SBI, HDFC, Union Bank, and so on. Most likely your local bank. At number two, we have NBFCs or non-banking financial corporations such as Credila, Avance, and many other companies. And at number three, we have our local government schemes based on the state that you are from. So you need to start working on your loan application from the very day that you are applying to colleges abroad, as most lenders take anywhere from 2 weeks to a month to approve a loan, especially if it includes collateral. Then it can take 1 month to 2 months to get your loan approved and sanctioned. Meaning, to get the loan approved is one part, and second part is to get the amount disbursed to your account from the date of application. So whenever we are looking at loans, there are two major questions you need to ask before finding the right lender for yourself. Number one, what is the interest percentage of the loan that you are getting? And number two, is the loan going to be with a collateral or without a collateral? Other words for collateral are, is the loan secured or an unsecured loan? So collateral is basically when you borrow money from the bank. So you usually have to give something to the bank as their protection or safety. So usually what banks accept are property papers or a gold loan. So these are few types of collaterals that usually banks take. Now, depending on the type of loan you are getting, you can ask the bank what type of collateral you would have to keep in terms of getting a loan. It is basically protection against the funds that the bank is giving you. So if they give you a loan of 40 lakhs, you would have to keep an asset worth 40 lakhs or more with the bank. In case you don't pay, then those will go directly to the bank. All of this is written on the contract that you usually make with the bank, and hence we have to check multiple different lenders to make sure which one meets your criteria to get a loan. So a lot of students ask me, so what is interest? Well, amount that you take from your traditional bank usually comes with an interest. So say if you have borrowed 1 lakh from the bank and it is at 10% interest, then at the end of 1 year when you're repaying the bank, you have to not just repay your 1 lakh that you initially borrowed, you have to also pay 10% of that, which is an additional 10,000. So for the 1 lakh you borrowed, you're now paying the bank back 1,10,000, and the difference is basically the interest by which your amount has appreciated, anywhere from 9% up to 12% for an educational loan. So now that we've covered collateral, let's get into the first type of loan, that is your traditional bank loan. Now, one thing that is common with traditional banks is that there always will be collateral, that is security that they will take, and also there will always be interest. Mostly the interest rates for traditional banks range anywhere between 9% going up to 11.5% on the loan that you take. So a lot of people ask me, why is government banks taking collateral? Well, for other courses or for other master's degrees where the course is only 1 year or 2 years, government banks may not take a collateral or security. But what happens in the case of a medical degree? A medical degree is 6 years long, and it takes 6 years for the bank to make the money back. And hence, for 99% of medical colleges, if a bank gives you the loan, they will always take a collateral or security from you. Well, this is mainly for medical colleges, but also other courses that span for a longer period of time. So there's one thing to keep in mind when looking for traditional banks. They give up to 7.5 lakhs without collateral, and anything over 7.5 lakhs, usually they will take a collateral specifically for the medical degree. So this is how our traditional banking system works, and probably the most secure way to take a loan. Yes, you have to put collateral up front, but the rules and regulations of the bank have to be in strict adherence to the RBI regulation. And moving on, at number two, we have NBFCs or non-banking financial corporations, or in simple terms, private lenders. Who are these and how can they help you? Now, why would somebody go with a private lender? It is for one reason only, and that is zero collateral. In case you take 40 lakhs, they will give you 40 lakhs without collateral. But the interest rate is higher by usually 1 to 1.5% in these kinds of loans. So few things to keep in mind when looking at private lenders is number one is the interest rate. Now there are two kinds of interest rate. One is fixed and floating. You need to make sure your interest rate is a fixed interest rate so that no matter what is the duration of the loan, the interest rate does not change. Number two, you need to make sure to be aware of any processing fees or hidden costs. Now, usually private lenders have a huge setup fee of 1 lakh, 2 lakhs. So make sure your lender is not taking any other setup fee from you besides your actual loan which they are going to give you. Number three is loan term and repayment flexibility. Now you need to make sure the exact time you have to repay your loan and also how quickly can you repay the loan. Compared to your traditional banks, private lenders have a slightly higher rate of more than 1 to 1.5%, but they give you the entire amount without any collateral, which is a game changer for students when looking to take an education loan. And at number three, we have your own government scheme depending on the state that you are from. The Goa Scholar Scheme, which is basically for high performing students from the state of Goa. Now, these students that are high performing that apply for this scheme get their complete education paid for by the government of Goa. But for that, there is a meticulous process that you need to go to, which includes firstly getting your education documents verified and having a score of over 90 to 95%. Number two, you need to get accepted into the top 100 universities of the world, or the best of the best, such as the Harvards, Yales, and the top universities in Germany and across the world to be eligible for. And number three, you need to pass a test and an interview process by the Goa government in order to be eligible to get the scheme. So 3-step process for the Goa Scholar Scheme. All in all, these are the main types of loans that you can take. Again, at number one, we have your traditional banks, which require collateral and have interest. At number two, we have your non-banking financial corporations or private lenders that take an interest rate of just 1 to 1.5% higher than traditional banks, but give you an entire loan without any collateral. And at number three, we have your own government scheme and depending on the state that you are from. And now to the most important part is the repayment. And how do we repay these kinds of loans? Now there are three major types of repayments, and depending on your lender, this may vary. Number one is your direct EMI, where from month one you start paying EMIs of your loan. And this is how our local banks take the repayment, that is from month one itself. Now how to calculate that would be done from the lender that you take the loan from. The second type of repayment is an interest-only repayment scheme. It means that the parents would usually pay off only the interest for the first 2 or 3 months and only leave the principal amount that you have borrowed to repay upon completion of the degree. So if all the interest is paid off in advance, upon completion of the degree, the child does not have any additional amount to pay. So most people, if given the opportunity, choose the interest-only repayment method. And last but not least, at number three is repayment upon completion of your degree. Now, some lenders give you a duration of up to 15 years to repay your loan, mostly done again by our traditional banks, which means that you will start paying your loan only after completion of your degree, and you have a total of 15 years from the day you have borrowed the funds to repay the entire loan. And this again is a very popular repayment method for most education loans. Now, one tip that I will give you when looking at private lenders or any other loan for that matter is whenever you take a loan, try to make sure to clear it as soon as possible. Just because you have 15 years to pay off your loan, don't think that you will start paying it after 6 or 7 years. Well, you need to try to clear the loan as soon as possible, because right from the day you receive the money from the bank or lender, your interest rate starts. And when your interest rate starts, the money that you owe compounds, multiplies over time. So make sure if you take a loan to work from day one to repay the loan. And with this, I hope you've got an overall understanding of how education loan works, at least for the medical field. If you have any questions or doubts regarding loans and how you can apply for one, feel free to reach out to us on the number down below. And like always, all the best, and I'll see you as a doctor.